All right. Hello, FounderHub community, and welcome to our AMA sessions. Our guest for today is Adrián García. Adrian was actually a board member in my first company, and he later went on and co-founded Carao Ventures, which is both an accelerator and soon to become an investment firm in itself. They invested in Slidebean and concurrently in FounderHub in our 800K seed round back in 2015. So Adrian will be here to answer any of your questions around Carao Ventures, their scope, and their industry insights, and any questions that you guys might have, surrounding investment or how to raise capital, which has been a recurring topic for many of you. So as a reminder, if you're part of the FounderHub Slack community, we'll prioritize questions that we get from the community members. If you caught us on our YouTube live, feel free to ask and comment in the chat, and if you're listening to this on our podcast, well, that's tough luck because this has been pre-recorded. So you should join us next time for a live session. So I have some questions for Adrian that I'll start asking him before questions from the audience start kicking in, and we'll get started. So Adrian, tell us, why do you feel Latin American startups fail or are less likely to raise investor capital?
Well, there's a variety of reasons, but I think one of them is that, especially in large markets, some startups that we're seeing are trying to copy or become copycats of large established startups in the US or Europe, right? So eventually, that's not going to be that competitive for them, and might be a little bit of a problem, right? So startups, even in small countries or emerging regions in the world like Latin America, same comment would apply to Eastern Europe or some similar parts of the world. And they have to really they need to build something that is truly differentiated and innovative, because if they grow and if they grow a lot, they're going to be competing in other markets, including developed markets, US, Europe, Israel. So in our experience, I think the company has to really have something innovative on a global scale. Otherwise, eventually, it's not gonna work.
So I guess it relates a little bit to that question. So should tech startups aim for the U.S. market, or is it okay just focusing on the Latin American market alone?
Yeah, there's no right reason for that question. I think we have seen companies that have been really successful focusing on one particular market. It could be one country, it could be one city. A lot of startups start in San Francisco or New York, and they stay there until they have critical mass. It depends on what you're building, right? The actual problem could be something that a lot of people face very similarly. But take the example of building accounting software. So accounting is something that has very specific rules in each country and each even state in some places. So maybe it's going to be hard to build an accounting software at a small scale when you have to figure out where do you want to start in the US or Latin American country or some other place in the world, right? So there's really no right answer. The challenge I think that startups may have after they tackle the first market is where to go next. Because if they are really successful at a first market, it might be because they really learned and know the customer really well, but the customer in some other part of the world might be very different, right? So it depends, would be my general answer.
So I guess that this applies a little bit to our own country, right? We see startups that launch in Costa Rica that are focused in the Costa Rican market with the expectation to eventually translate or copy this model into maybe the rest of Central America or other countries in Latin America. But yeah, would you say that? So what's the best approach in this case? Should you aim at an initial larger market, or is it okay to start with such a small country? I guess that applies to many of the people listening who are not in the US or in such large market.
Yes, again, so going back to my first comment, if you end up deciding starting at a small country in an emerging region of the world, or a mid-sized city in the US or Canada or Europe, the founders have to think about how are they going to be innovative in the long term, or at least in the medium term, because let's go back 20 years, and my friend Kaya and I decided to start an email hosting company. So we're going to host email, and we're going to provide and sell email accounts, right? So that might be good in the beginning, and we might launch in the US with some marketing online, or locally in Costa Rica or some other country handing out flyers. The problem is that Google will eventually arise later, and it's going to be incredibly competitive, cheap, and have a lot of other attributes. So again, there's no right reason for it. It's okay. It's very okay to start in a small country like Costa Rica or similar one, because it's going to be your pilot market. Ideally, the one suggestion is that the place you decide to use as your first pilot or test market, you have to study the end consumer, the customer, because you might be in a place that does not have a lot of customers that are your ideal customer profile, right? So you might want to move to the US if that's the case, because people use technology a lot more, or you're targeting a problem that does not exist in Costa Rica. For example, software that has something to do with snow or ice, it definitely wouldn't apply here. So you would definitely have to move. So it depends on the problem you're tackling. But it's not a problem at all to start at a small place. Again, thinking about how are you going to be competitive? How is this startup, this product, this founding group? If you don't think about that in the beginning, you're going to be facing that later on, which could be a problem. Then. Even if you start as a small country, you do have to study all the competitors in other places, even not only US, but there might be a super cool company starting in Estonia that is doing something similar. So you have to familiarize yourself, adapt and learn from all the similar things that are happening around the world.
Let's move into the subject of traction, which has had a lot of traction in our recent publications and videos. When should a company approach you guys, or when should a company approach an investor in general? Kind of like our classic issue with Slidebean is we have all these companies that have built their pitch decks, that have solid pitch decks, but their business is just not there yet to raise money. And there's this, I believe, sometimes naive concept that no traction can still get you around. What do you make of that?
Yeah. So first of all, raising money from an investor, an angel, or VC, early stage investing company, is normally the last stage of a relationship, or the last stage of some initial part of a relationship with such investors. So your goal is not to raise money. Your initial goal is not to raise money from an investor, is to build a relationship with them. So taking part of these communities, going to your local meetups, and most importantly, getting references. I put my LinkedIn profile in the Slack channel. So for example, if you're looking at investors that you want to meet, it's ideal that you find someone that can make you an introduction, because that investor might feel a little bit more comfortable rather than an email over LinkedIn or cold email or something like that, because you might think that email has been sent to other thousands of folks in a lot of places. So in regards to traction, that's going to be question number, 12 or 13, or there's a lot of initial questions that investors try to tackle first. Okay, who are these people? What are their references? What is their experience? Can they produce this is very important, but can you produce and write without typos a succinct email or presentation on Slidebean, or something that makes us think that you really care, and it's not a one-liner saying, "Hey, let's meet in your office. I'll swing by tomorrow." That's one, especially for us, and being so close to Slidebean, is one of our most important tests that entrepreneurs don't really know. We want to see high-quality interactions. It could be on a Slack channel or an email that is very well written and thought of. It doesn't have to be long. It can be 3 lines, but really thought of. References, it doesn't have to be 100 slides, but a very good, solid Slidebean presentation or PowerPoint presentation, with ideally Slidebean, of course, without typos, well written, has a story. I mean, all these communication aspects are really, really important because it creates the first impression in an investor, right? Even with the best reference, after someone introduces a startup to us and they send us a 2-slide presentation with typos and font number 8, that's going to be not that great, you know. So it's a combination of everything. And going back to the traction question, I mean, it depends on the product you're trying to build. There's no real number because, I mean, you can have 100 customers that, and every customer is a contract of $10,000 per year, and that's going to be great. But you can have 100 views in your website. I mean, there's no real number. It depends on the KPI you're trying to follow. Having views on your website is okay. Having followers on social media is better. Having real people that have interacted with your product, even better. And real people that are not your cousins or your neighbors or your friends that are intrigued by your product and mention interest in potentially paying you, that's much better, right? So you gradually advance in this problem market fit, and we don't have a specific, and I'm sure investors don't ask for specific numbers. They just want to see that you talk to real customers, that you tackled the problem, and that you're advancing in getting those two things together. It's better to have 10 real customers that are paying you, that are happy with your product, that are contributing to feedback for future iterations, than 1,000 customers that you acquired via ads. Very fast. They're gonna turn out fast, you know. So it depends. But traction, what you want to see is that you have external people out there, the real market, that has faced and seen your product and likes it at that stage, at an initial stage.
How do you think? So let's talk a little bit about that relation between traction or that company stage. Here in Latin America and compared to the US? That's half the question. And then how does that stage relate to valuation? So that's again, it's been a recurring question in our networks. You know, how do you value a startup in this stage? Yeah, go ahead.
So valuation, of course, is a tricky question. The valuation of any asset is basically the price at which someone else will buy your asset. A building, a car, a stock certificate, or a percentage in your startup, right? So the challenge there is to meet the demand, right? So you're the supply. You're supplying the market a potential investment in your company, right? So number one, where's the demand? So we talked before about how to meet and interact with investors, and then you have to talk to them, and you have to send documents, interact a few times, and then okay, what number do I put in my valuation slide, right? It's going to be 500,000, 1 million, 5 million. I don't have a clue. Again, I mean, do your homework. Investors are going to have very fixed ideas, sometimes with some flexibility in what is the value of a company anywhere, right? It has to do with the quality of the founders. It has to do with how much money have you already raised. Have you raised zero in this round, or $10,000, or $1.9 million out of $2 million? So, I mean, it's basically matching supply and demand. When my first very general and actually very superficial advice there is that if you Google startup valuation, there's a really nice infographic that appears there that most of you or some of you have probably seen. I like the part where they estimate a little bit in certain ranges. Okay, if your startup has just started and it's you and your friend, and you are doing it full time and your friend is not, then it's probably $0 to $200,000 in valuation. Okay, your startup has customers, they're ideally paying you in a recurring way every month. Decent churn rate, your product exists, is in the market, then maybe your startup is worth between 200,000 and $1 million. I think they explain it in more detail, but the the value of a company is very subjective at the early stage. So you have to picture yourself in the range that would be acceptable to an investor. And ideally combining that with how much money have you already raised. You can have an outrageous scenario where you don't have a product built. You are alone, maybe with someone else that is sort of helping you out, but you're really persuasive, really highly connected. You founded 5 companies in the past, and so maybe you can pull off a 10 million pre-money valuation, or let's say just 10 million with only a presentation and your contacts, right? It depends on how well connected you are, where are you situated, where are you raising money, but try to think of yourself in, or situate yourself put yourself in certain brackets, and try to test and figure out where are the comparables to the value you're trying to get to. Okay, is my startup worth $100,000? Do I have a product built? Okay, maybe it's a little bit cheap. Do I have 1,000 customers paying me $10,000 a month? Maybe $100,000 of valuation is really low. So how about 10 million? So you try to again fit in one of these buckets and ranges of valuation. Crunchbase, all these databases that are available online. You can find startups in almost any sector, similar sectors that you are, where you're building your product, and you can find, 5, 10, 15, 20 startups. Information is normally available at what valuation did investors invest and so on. And so try to compare yourself to all those companies in a similar sector with similar geography, a similar product, and then maybe you can have a better idea on how to fine tune your value. And the best test is a conversation with an investor that is going to eventually lead you to a strike price where the supply and demand meet, and that's your valuation. It's not something, it's so subjective in some instances that getting into a very technical, detailed, specific negotiation with an investor might be counterproductive, because it's basically assumptions over assumptions. So you're going to be trying to hone in a range where both parties feel comfortable with. And lastly, it's counterintuitive, definitely, but you're not trying to maximize valuation. You're trying to find the optimal valuation at which an investor would be interested in investing in your company, that allows you to move to your next milestone, and doesn't create a wall for a next round, a price that is too high, at which you might be able to find, or you will be forced to do a down round in the future. So you're super lucky to raise money at $10 million of valuation, and then you don't grow as much as you said you were going to grow, then it's going to be a problem later, because investors are not going to find that valuation reasonable, and you're going to have to do a down round. The down round is basically a process where you take money at a lower valuation than a previous round, and that creates some friction to go forward if you actually are successful in raising more money.
What one of my last questions, and again, if to the people in the audience, to the people watching on YouTube and on the Slack channel, this is an AMA, so if you want to ask some questions, just go ahead and do it in the chat or in the FounderHub community Slack. Again, following up with another one, what are non-fundable companies? Maybe without naming names or without without revealing who they are or too much about their product. What are non-VC fundable companies that you've come across? A company that tries to raise or that believes it can raise investor capital and maybe is it because the market is not large enough? Is it because it's not scalable enough? Like, what makes it a non-fundable company, and where can those companies go if they need money?
Good question. Yeah, I was revisiting the story of venture capital that started in the first company that did venture capital started in Boston. It was called American Research Corporation, and it funded products related to the military that were highly promising for other uses in industry. Venture capital was created to fund high risk, high reward companies. So if your company is a business that is a business that is trying to sell a physical product. So maybe to sell online on Shopify, Amazon, or something like that. Maybe there are alternatives to venture capital. Venture capital is looking for a high return, and they're willing to take high risk as well. So if you have a small business, and even for a startup, I think a good advice normally is to figure out all the seed capital, grants, soft money, non-dilutive capital, non-dilutive grants that are available in your city or in your country. Most countries now, or cities, I've seen medium-sized cities in the US that have really interesting seed capital, non-dilutive grants that are available. So try to find those, see if they apply, and utilize those first, because those are going to be cheaper than giving out shares of your own company. So normally that's a good way to start. A physical business, is it a complete no-no for venture capital? Not necessarily. There's an interesting case in California. Some of you have seen this company called Blue Bottle Coffee. They provide, it's a coffee shop, and they have really, really good quality coffee, but it's a coffee shop or chain of coffee shops. Some funds invested in this company because it has a really promising e-commerce part and bundles and things that they sell, showcasing at their stores. A competitor of Lululemon, the yoga clothes called Outdoor Voices, also received venture capital. They sell yoga clothes and gym clothes, but they have a really promising and much bigger online site where they sell their stuff besides their physical stores. So not necessarily because you're selling a physical product, you're going to be out of this financing possibility, but there has to be part of the story that is compelling to angel or venture capital investors in regards to high growth. It could be e-commerce. Of course, if it's a software product sold online to the world, that's a lot easier to answer. But there are very specialized venture funds for each specific industry: biotechnology, hardware startups. There's other sectors called hard tech. So if you're building machines or things that are really difficult to build, there's an interesting accelerator fund that MIT in Boston started that has a really long investment period. So they invest, their fund is, if I'm not mistaken, 20 years, has 20 years of life. So imagine a space industry, I don't know, of course, AI or things that are highly complex. There's even investors for that. But
sorry,
yeah.
Somewhat related to that, forwarding a question from JPW. Is pre-seed funding from crowdsourcing platforms still a thing, or has it lost its clout?
I don't think so. I think I just answered to you on Slack. I love WeFunder.com, for example. One of the co-founders studied with me, and it started with only high-tech software companies, but now I love it because they have craft beer and cookie companies next to space exploration technologies and other fields. So I believe that there was a boom some years ago in of course Kickstarter and all these platforms, Indiegogo. But then I think once that gold rush settled, each of those platforms pivoted or focused on the verticals or the sectors where they saw they had a demand, right? So WeFunder, as I said, now has a really interesting combination. I love it almost as a magazine. Okay, what's available on WeFunder today? I recently invested in a cookie company based in San Francisco, and they just make cookies that they sell online. Amazing cookies. I've tried them. But
what's the name? Because maybe I know them.
The Cookie Department.
Oh no.
But anyway, so I think it's similar to cryptocurrencies. We're not going to talk about cryptocurrencies today, but imagine that crowdfunding is just in the first stages of development. Although we might think today that the world moves particularly fast. Yes, it does. But as it moves fast and changes happen and all these platforms evolve, I suggest that you search for the crowdfunding platform that applies to your geography. I know that Israel, for example, has a lot of really interesting crowd investing or crowdsourcing platforms for investing, however they're called, that might apply better. There's an issue still with money. How do you get the money? If you're using Kickstarter or AngelList or one of those, you need to have, most probably, even we funder a US based corporation. So if you're sitting in Argentina or South Africa, it might be difficult to do that unless you can easily set up a US corporation. And FounderHub is helping in that regard, in sort of putting together some of the resources that are available to start a company globally.
Yeah, actually, speaking a little bit from my own experience, we successfully funded a Kickstarter campaign for the company I mentioned that Adrian was a board member of. That's actually how we met. We launched the Kickstarter campaign and Adrian reached to us. But yeah, what I really like about Kickstarter, which is still alive, we don't hear a lot about Kickstarter projects anymore, but it still exists, and a lot of companies and projects get funded that way. I think that the real value of Kickstarter is that it validates your idea or your concept or your product with a bunch of people. Like, really, you're asking people to pay in advance or to donate or whatever you want to phrase it. You're asking people to give you money in exchange for the promise of this product. And that is a fantastic validation. The Kickstarter story got us a lot of press back in 2012. Maybe it's not as press worthy anymore, but it got us that initial credibility to raise the little money that we raised with that company. Because again, you prove yourself that a few hundred or 1,000 customers are willing to give you money for it.
I would say that crowdfunding is also, besides what Kaya was mentioning, a good experiment and exercise to promote your company. The bar has been raised a lot because there's been scams and things. I mean, projects that have not been successful. So getting a project accepted on Kickstarter today is much harder than it was some years ago, and also in all these other platforms, because there's a lot of people contacting them to put products or services or software on these platforms. So you really have to think about what pictures, the copywriting, how do I describe the thing, because I want to take the money, I want to take my money, for this product or service that I'm trying to sell. So it's, in my opinion, a lot more competitive now to be successful in these platforms, and that's okay, because again, it's an exercise in promoting, an early exercise to promote your product. There's also problems associated with it, or maybe not problems, but things you have to think about today in regards to launching a physical product. There's been some people are worried in launching early on Kickstarter, some of these platforms, because some people might copy you and actually produce your product before you actually produce it yourself. So if you're doing something highly innovative that is a physical product that is in the process of a patent, maybe try a different channel. But in general, I think we're seeing a natural development in all these crowdsourcing platforms, and it's going to be exciting to see how they develop in the future.
Fantastic. So we are running short on time now, so we're going to wrap this one up. Thanks a lot, Adrian, for being with us and for actually coming into the office. I don't know if you noticed, but he's sitting here in the studio. So I hope this was useful for you all. Thanks to the FounderHub and the YouTube community for participating. I encourage you guys to sign up to the FounderHub community at founderhub.io. So again, we take questions directly from the Slack community, and we have events going on every day. So tomorrow we'll have a demo day. What we do every Wednesday is we have a company pitch and then get feedback from the community. So you already know Adrian's handle on the Slack channel. So feel free to send him a message if you need him. And then hit that subscribe button to stay in the loop on the new content that we're generating. We will see you next week.